Okay. Good evening, everyone. Welcome back to our session on financial management via Incar. I can see many of the students have already joined. Good evening. Very good evening, everyone. Very good evening. Okay, fine. So, in the previous class, we were discussing about what the subject of FM is all about. And we have started with the sources of funds, various sources of funds, right? We have completed few sources. We have to discuss some more sources of funds now. So we'll discuss the sources of funds in the first half before we go for a break. And in the second half, we'll begin with the chapter of ratio analysis. Okay, fine, guys. Great. Let's straight away touch on to the topic, which is the sources of finance. Right now, in the sources of finance, we have discussed the domestic sources. Uh, we have discussed the equity portion, or the owned funds portion is fully discussed regarding the domestic as well as the international, right? And now we have to discuss about the borrowed funds. Okay. So in borrowed funds, we have discussed seed capital. We have seen what is zero coupon bond, what is secured premium notes, and then unsecured loans which are provided by the promoters, which is basically the quasi equity. Correct. Now let's go for some international sources of funds. That is at global level, how we can raise the funds. So when it comes to international sources, the first and foremost thing comes up is the development bank, is a series of the development bank. Okay. Now these development banks are international organizations which basically offer loans on a global level. So these development banks offer a number of concessions to the foreign companies to invest within their country and to finance exports from their country. Like in example, in India we have the Exim Bank. Similarly, you can have Bank of USA, which provides capital to the foreign companies so that they would invest in their country and they would promote sales or export from there. Okay, so that's the first and foremost criteria. That's about the development banks, which is operating at a global level, providing funds to the international companies for setting up industries in their country. Okay. Tanvi, I'll be uploading the notes by today because we'll be completing this topic today. So I'll be uploading this. Okay. Then we have floating rate notes, which is having a 7 years maturity. Generally, the floating rate notes or basically which will reflect the foreign, the exchange rates. They have 7 years maturity. The interest rates are adjustable, which will reflect the exchange rate, and they are supposed to be cheaper than the foreign loans. So the rate of interest on this type of note or on this type of debentures, it depends on the exchange rate. So whatever will be the change in the exchange rate, however way the exchange rate fluctuates, we can say that exchange rate fluctuation will be captured in these bonds. So if the rupee to dollar exchange rate changes, the rate of interest on these notes or these debentures sort of thing will also change. Okay. Then euro convertible bonds. Euro convertible bonds. These are again international sources of debt. Now, when you say convertible, what do you understand by this convertible term? Tell me, guys. What do you understand by the term convertible? What do you mean by convertible? Any idea? Convertible. You might have heard about convertible preference share, convertible debentures, right? So, what does it make sense to you? What sense does it make to you when I say convertible? Any idea? Convertible debentures or convertible bonds? Definitely, sir. They will be getting converted to equity shares, right? They may be getting converted to equity shares. Uh, so your debentures will automatically become equity shares. The same way, euro convertible bonds are also on the similar lines, in which this provides an option to the holder to convert the bonds into equity shares. So whatever bonds are there, they will have an option. They will give the bonds give you an option that they will convert those bonds to equity shares. Now they may be callable or puttable. Now understand what are these terms callable and puttable. Callable, it means the company can redeem the debenture or redeem the bond before maturity. Before maturity, before due date, also the company can redeem the bond. That's the callable bond. Puttable bond means these are the bonds which, as an investor, I can give it back to the company and ask for the money. Okay, so they may be callable or puttable. So callable means company can redeem it before due date. Puttable means investor can redeem it before due date. Investors can give the bond back to the company and ask for the money before due date also. So that's what we mean by callable and puttable bond. Generally, if you don't have this callable and puttable option, that bond is not supposed to be, retired or paid before maturity. It will be paid only on maturity. But when you have this sort of feature that the bond is callable or puttable, it means the bond may be redeemed before due date also. Okay. Then next that we have is external commercial borrowing. External commercial borrowing. So external commercial borrowing means it has a commercial loan from non-residents with a minimum maturity of 3 years. Right. So you can borrow money from external sources, from international agencies sort of thing, which will provide you loan for a minimum duration of 3 years. Lenders can be institutions like International Financial Corporation, Asian Development Bank, or export credit agencies, right? And these are like automatic route and approval route. So both the ways are possible that you can borrow with the automatic route. Now, when you say borrow with the automatic route, it means you can borrow money without taking approval of Ministry of Finance. Approval route means there are certain cases in which you need to take the approval from the Ministry of Finance. Okay, so that's what we mean by external commercial borrowings. Okay, so these are the borrowings from the international institution which provide you for a minimum maturity of 3 years. Okay, then we have some special type of bonds which we need to focus is, see, there are bonds which are issued in USA. It means the bonds are issued in USA. Now, of course, if the bonds are issued in USA, they will be denominated in dollars, because as we discussed in the previous class, those US guys will not understand. US guys will not understand what is dollar, what is rupee, or what is any other currency. For them, dollar is what makes sense, right? So when I'm going to issue any bond in US, I need to issue it in dollars only. So any US company investing in US, obviously it will raise money in terms of US USD, and it will invest in US market itself. But suppose I being a Indian company, I want money to be brought in India, and I want to make investment in India, but not through equity means. I don't want to issue any GDR or American Depository Receipt. What I want is debt funds. I want to borrow. I don't want to raise equity. So when I want to borrow, I go to the US market. If I issue my rupee denominated bonds over there, if I go ahead and issue rupee denominated bonds over there, then it will be quite difficult for me to raise it, because US citizens will not understand rupee term. So for them to understand uh, what we are talking of is, I need to issue the bonds in dollars. But who is going to issue? Sir, we as an Indian is going to issue. Okay. So it means you are a non-US bank or a corporation. So when a non-US bank or a corporation goes to US market, issues dollars, issues dollar denominated bonds, those bonds are typically called as Yankee bonds. Those bonds are called as Yankee bonds. Okay. So what do you mean by Yankee bond? Any non-US company going to US market, any non-US company going to US market and raising money through US debt instrument or USD terms, that's what we call it as Yankee bond. So any, let's say, African country going to USA, issuing bond which is denominated, the currency which is written in the bond is dollar, but that is issued by whom? The African country, or that is issued by any Indian entity, or that is issued by some European entity. So those bonds are called as Yankee bonds. Okay. Now, when I want to issue bonds, similarly, Japan. Similarly, suppose I want to issue bonds in Japan. Now, when I say we want to issue bonds in Japan, it simply means we want a non-Japanese company going to Japan and issuing Japanese yen denominated bonds. So, for example, being an Indian company, let's say, Infosys wants to raise money from the Japanese market. If the Infosys wants to raise money from the Japanese market, it need to issue samurai bonds. It will have to issue samurai bonds in Japan. But what is the currency that the non-Japanese company is going to get? What's the currency that non-Japanese company? Obviously, it is going to get Japanese yen. Now, when it wants to bring money to its home country, it need to convert it, right? Similarly, being an Indian entity, if I want to go to the UK markets and I want to raise pounds, then I, being a non-UK company, going to UK, issuing bonds in terms of pounds, those bonds are called as bulldog bonds. Okay. Are we clear with all these three types of bonds? Are we clear with this? All these three types of bonds, guys? Yankee, samurai, and bulldog bonds. Is it clear? Yep. So any country entity going to some other country and issuing bonds in their currency, they will have some special name. Like in US, we say it as Yankee. In Japan, we call it as samurai, and in London, we call it as bulldog. Similarly, uh, just for your knowledge, we call it as in Canada, it's called as maple bonds. In Canada, it's called as maple bonds. If you uh, issue it in sort of India, those are called as masala bonds, right? Okay, so a foreign entity, going to the other country and raising bonds from there, raising money in the form of debt from there, has got some special names for it, bonds. Okay, fine. Then um, specifically that I wanted to discuss about is this term, securitization. Securitization. Explain once again. Which one? I think I just explained it, right? Yeah, yeah. Durga, just understand that these bonds are issued. Suppose I want to issue bonds in US, but I'm not a US company. Okay. Let's say ICICI Bank wants to issue bonds in US. It'll have to issue bonds in dollar terms. It'll have to issue bonds in dollar terms. So of course, that non-US company like ICICI Bank, it is going to US and issuing bonds in terms of dollars. That's called a Yankee bond. Similarly, when you go to Tokyo, Japan, you issue bonds in Japanese yen. That's what we call it as samurai bonds. And same goes for bulldog bonds also. Okay. Yeah, you can say that names are kept according to the the country for the names for which the country is typically famous, right? So in Canada it's maple bond, in India it's masala bonds, something sort of that thing, right? Okay, so we'll discuss about this term called as securitization, and it's a very interesting topic, guys. Okay, let me just explain it to you with the help of an example. Okay, let's have a look at it. Okay, let's learn about this very interesting topic called as securitization. Okay, so what happens in securitization? Let's try to understand it. Okay, let's say we have on one side uh, State Bank of India. Okay, now this State Bank of India, it is having in its balance sheet. Can you guys tell me in its balance sheet asset side what will be major portion? What will be major portion in the asset side of State Bank of India? What would you find on the asset side of State Bank of India? What would be the major thing over there? Yeah. Will it have machineries? Will it have machineries? Is it going to have machinery, any furniture, something of that sort? Is it going to have like that? Of course not. Assets in the major side, you will find that on the asset side, it will have not debtors, receivables. Come on. A major chunk of it would be loans and advances. A major chunk of it is going to be the loans and advances. Because what business is into State Bank of India? State Bank just receives money from the public and it gives loan, right? It gives loan to the public at large or to the specific industries and charges interest. It pays interest on its deposit, charges interest on its loans that are given out, right? Now let us consider a typical case. State Bank has given loan to lot of public with regards to the home loan. Okay, so it has, let's say, home loan portfolio. It is having a home loan portfolio, and that typical home loan portfolio in which State Bank would be earning interest. Let's say total home loan given by State Bank stands as 1,000 crore, 1,000 crores, and rate of interest that State Bank is charging is, let's say, 9%, for example. So this, from this home loan, from this home loan portfolio, State Bank is receiving interest at 9% per annum. But don't you think this 1,000 crores that State Bank has granted loan, that my bank has granted loan to the public at large, on which it is earning 9%, that is blocked. That is not available for State Bank of India for any further investment, right? Can State Bank of India go around and ask all its home loan borrowers that give me the money back? Can it do it? Can it do it in that way? That I have granted you, let's say, 1 crore of loan. Now you cannot have it. You have to give. You cannot have it for longer term. You have to pay to. Can it do in this way? Can it just go ahead and ask for the money from all its depositors, all its borrowers that give the money today itself? That's not possible, right? Because State Bank would have granted loan with a typical tenure, with some tenure, maybe 20 years, 10 years, or 30 years, right? So for typical that tenure for that time period, this amount is blocked in the State Bank assets. This amount is blocked in the State Bank of India assets, right? So now, how do we think about liquidating this thing? How do we go about liquidating this thing so that State Bank will get money off? Okay, the State Bank will do one thing. It will approach or basically it may also create a special purpose vehicle. It will create a special purpose vehicle. Okay. Now, special purpose vehicle, it may be established as a SBI, some maybe securities limited. A new entity will be established. A new company will be established, and this entire 1,000 crore loan will be given to this SPV. It will be transferred to this SPV. So when you say 1,000 crore loan is given to SPV, is transferred to SPV, what does that mean? Tell me, who is having the right to collect money from this home loan, from these borrowers? Who is having the right to collect the funds from these borrowers? Who is having the right to collect money from these borrowers? Tell me. Originally, who is having the right? Bank. The State Bank is having, right? The State Bank has a right to recover money from them because it has granted loan. Right? Now, what State Bank says is, okay, I have the right to recover money from these people, but I want liquid funds. I don't want just the interest on these funds. I want liquid funds available with me so that I can, invest it in some other areas. So State Bank will approach this SPV. The State Bank will approach this SPV, and the SPV will be asked. Originally, the SPV, right? Yeah. Then the SPV will be asked one thing, that SBI will say, you take this entire loan from me. You take this entire loan from me, right? You take this entire loan. I'll give you the entire right to recover money from these people. It means SPV will have a right to cover money from this. But sir, is the State Bank of India going to do this free of cost? Of course not. State Bank of India will say to SPV, he will say to this special purpose vehicle that is specifically created, that you do one thing, against this 1,000 crores, you pay me maybe, let's say, 990 crores. This is a loan of 1,000 crores. It means State Bank has a right to recover money. State Bank has a right to recover money from these people. Now, this right, this power, we are transferring to SPV. This power we are transferring to special purpose vehicle, and that special purpose vehicle is going to provide us 990 crores. Now think from the point of view of SBI. Think from the point of view of SBI. Would you give away this power to SPV if SPV is giving you 990 crores? Yes or no? You have a right to recover money. You have the power to recover money from these borrowers. But instead of collecting money from these borrowers, you are saying that I'll give this right to SPV and SPV is going to give me 990 crores. Will you transfer this? Will you transfer this right to the SPV? No? Why no? Why won't you transfer this right to SPV? Why won't you transfer this right to SPV? What's stopping you? Against your 1,000 crore loan, against your 1,000 crore asset, the SPV is giving you 990 crores. Why won't you transfer it? They mean to say it's better to, SBI should keep the money and, it should collect the money on its own. So there is a loss of 10 crores. Okay. Loss of 10 crores, fine. But understand guys, if SBI is keeping this money with it, if SBI is going to keep this money with itself, what will happen? It is undertaking the entire risk now. It is undertaking the entire risk because out of this 1,000 crore, you don't know how much we will be able to realize. Some of the loans may go bad debts also. Some of the loans may become bad debts also, right? Some of the loans will become bad debts. And I don't know, out of the 1,000 crore, maybe 100, 200, 500, or what proportion of the loan may become bad debts. But once I give this right to SPV, I'll give the right to SPV. You take away the loan, you give me upfront 990 crores. Can I say I am protecting myself from that bad debts? Yes or no? Yes or no, guys? If I give away this loan to the SPV, can I say State Bank of India is protected against the bad debts? Because tomorrow, if suppose one of these borrowers doesn't pay the money, who is going to bear the loss? Is SBI going to bear the loss? No, because once it is transferred to SPV, it's the SPV's headache to recover. It is the headache of SPV to recover the money. Correct, guys? True? Yes or no? So, even if SBI says, suppose if it is 990 crores also, then also it is good, sir. At least I am saving on my effort. I am saving on the risk. I won't be facing too much of the risk that I may not be able to recover some money. That's the SPV's headache. SPV will take care of it. All the legal cases will be taken care by the SPV. At least I am secure that I am getting the full value. Not full value, but I am getting a substantial value of my loan. Yes or no, guys? So obviously SPV will, if SPV comes up with a proposal and SBI is okay with it, like SBI is ready to bear a loss of 10 crores against protecting itself from bad debts. Obviously SBI will be, it's fine, we can go ahead with it, it's a good deal. Upfront, there is an upfront loss of 10 crores, that's fine. There's an upfront loss of 10 crores, that's fine. But full amount is recovered, right? Correct? Yeah. Right? Okay. Now I'm seeing some queries coming up. I'll come to that and I'll answer those queries. Okay. Karthik, Aditi, just wait. I'll answer your queries in a short while. Now my question to you is, sir, deal seems to be good. That you're losing 10 crore upfront, but you are saving on the future loss, future bad debts. So if the SBI is ready with that 10 crore loss, it's okay, upfront loss, but I'll save on the future interest or future bad debts, right? So if that's the case, SPV will transfer it and the loan will be cleared off. But then the big question arises, from where will this SPV get 990 crores? From where will this SPV is a special purpose vehicle? There are many special purpose vehicles, okay? It's not a typical single company. So my question is, from where will this SPV, special purpose vehicle, get the money? How will SPV have 990 crores? Will it print the money and give to SBI? How is SPV going to get this money? Can anyone tell me? Can anyone tell me how SPV is going to get this 990 crores? So how come SPV raises this 990 crores? What are the sources? By recovering from borrowers. No, Karthik. Payment 990 crores is upfront. Recovery by SPV will be in future. But today when SBI is asking for this 990 crores, how will SBI get this money from SPV? My question is, how will SPV, how will this entity get this 990 crores? Yeah, by issuing bonds. Perfect. So we have SPV. On the other side, we have public sitting with money and demanding for investment sources. So SPV will issue multiple bonds to the market. So SPV will issue multiple bonds to the market. Right? It will issue multiple bonds in the market. Maybe it will say it will issue probably 90 or maybe let's say 9.9 crore bonds. SBI will issue not SBI, SPV will issue 9.9 crore bonds of rupees 100 each. So it will invite the public that come and invest in my securities, invest in my bonds. Each bond is let's say 100 rupee, and I'm going to issue 9.9 crores. 9.9 crore bonds will be issued, right? So 9.9 crore bonds will be issued by SPV in the market. Lot of public will buy the bonds, right? So SPV will give them multiple bonds, and from the public, SPV is going to get 990 crores. 990 crores. Okay. So in this way, what is a reason for this SPV coming in? SPV acts as a middleman. SPV acts as a middleman for getting money from the public and getting that money invested in the home loan of SBI, in the home loan portfolio of SBI. Basically, that home loan is taken over by SPV. SPV gets those money from the public, and that is paid to the SBI. Okay. Right? Hiral Parekh, hold on. Angel financing is yet to be done. We have not yet discussed that. Right? So these are marketable securities which are issued to the public, and SPV will state to the public that I am going to undertake SBI home loan, and for that I am issuing these bonds. So you provide me funds for that. So people will invest and they will, have an access to the market. Now the question is, what does SPV earn from here? What is this middleman SPV earning from this entire transaction, from this entire arrangement? What is the earning of SPV? Because to do all these things, it will require funds. From where is that fund coming in, or what are the sources of income from which SPV is going to earn? Right? Okay. Now, this SPV is going to receive how much rate of interest on home loan of SBI? Tell me. How much rate of interest is SPV going to get on home loan of SBI? Yeah. What is the amount of, what is the rate of interest that SPV will earn on this home loan of SBI? Do you think it will be same 9%? Is SBI going to give the same 9% to SPV? No, sir. No. Rate of interest will be somewhat like this. Home loan interest will be received by SBI 9%. SBI will pass on the interest to SPV maybe 8.5%. So SBI is actually earning 0.5% as commission. 0.5% as commission. So SBI is earning 9%. It will pay back 8.5% to SPV. Now tell me how much SPV will pay interest on its bond? What is the interest that SPV will pay on its bonds to the public? To the public. SPV will pay probably half, and in between SPV will earn 1% as the margin. 1% as a margin. Okay. There was some network error. It's corrected. Fine. Okay. Yeah. So SPV gets lesser than what SBI has charged. SPV gets lesser than what SBI has charged, and SPV pays to the public even lesser than what it has received from SBI. So in between there is a margin for the SPV. Okay. I think video is now good enough. We good enough, guys? Uh, एक सेकंड वो पीपीटी शेयर. ओके. अब आ गया पीपीटी. अब ठीक है ना? ओके चलो. Fine. So that is about SPV, guys. So let me just quickly recap it. Guys. Just have attention. So this securitization process, the entire process of securitization involves basically three parties. One is the bank, which is having a bank which is having a huge chunk of loan which it wants to liquidate. Okay. Second is the SPV, the middleman, and third is the public. So bank with its loan portfolio with its right or the power to cover the money, it approaches the SPV and asks for a upfront payment against the loan. SPV uh, SPV gets this money paid to the State Bank of India, against which the SPV receives the power to recover that money. And that power to recover the money is given to SPV, and SPV is going to collect money from these home loan takers. Now, to give this 990 crores, how would SPV would have received this money? SPV would be issuing multiple bonds in the market. It would be issuing multiple bonds in the market, which the public will be buying, and that money or that proceeds will be given to SBI. Now, that's the fund flow that happens from public to SPV, then from SPV to the State Bank of India. Okay. Now, what is this SPV going to receive? It will receive loan interest. It will receive interest on this loan through SBI. So SBI will receive 9% interest, but it will keep 0.5% as a commission for itself, and maybe 8.5% will be passed on to SBI. Or sometimes it may be the case that SBI may transfer full amount to it. And out of that 8.5%, by keeping a margin, SPV will give money to the public at large. Okay. So, any method to calculate this 8.5%? Rahul is asking any method to calculate this 8.5%. That is mutually agreed, Rahul, between SBI and the SPV. Both the entities will mutually decide it. Right? How much interest on bonds will be paid? That's what I'm saying. Bonds will be paying 7.5%. Some people invested in bonds are home loaners. Possible that some of the home loan takers might be investors in the public, but you never know who are the loan takers over here. Okay, what is SPV? SPV is a special purpose vehicle. It's a special purpose vehicle which is created specifically for this, which is incorporated specifically for this transaction. Are there any standard SPV, whether there is likely newly incorporated entity? There are existing SPVs. SBI has its own, or you can also create a new entity for them. Okay. Can I explain it from ICI study material? It's the same thing. Radhika, you can just go through the ICI material also. It's the same thing. You can read it. I've just put it up in the form of a graph. If you really want to understand this topic, I have explained it to you, but a bit of in-depth understanding, if you want, you can just watch a video in YouTube, right? There's a YouTube in a video called as Subprime Crisis. A YouTube video named as Subprime Crisis. I think it's an animated video in green color background. You can read out that or look at that typical video, which will give you even more better idea, how this structuring happens. Okay. Is it linked with asset reconstruction company? No, Mansha, not asset reconstruction company. Asset reconstruction company is a totally different thing, which altogether buys the loan and then goes for restructuring of the debt. That is, the terms and conditions are revised. That's not a case over here. Okay, people pay for loan twice. No, Aditi, how will people pay for loan twice? Here, the people are investors. People would have invested money on it and they will be receiving interest. Over here, they are home loan takers who have taken the loan and who are going to pay interest. Here, public is earning interest. Here, these people are paying interest. Okay. Fine. So, is this securitization concept clear, guys? Shall we proceed for the next part? Very simplistic way of understanding securitization, in which there are three total entities in which SBI is able to liquidate its loan portfolio and utilize that money for some more profitable ventures, right? Yeah, are we clear with this securitization concept? So we can go for some more concepts in this sources of finance. Shall we proceed, guys? Yeah. Okay, great. Any queries in this securitization case? Here from this chapter, you can get theoretical questions. Rahul, we have ratio analysis one chapter, and there is one more ratio analysis one lecture, and one more lecture is there later on. Need not worry. We have half of our lecture today and also of Thursday. What is the purpose of this structuring? It's pretty simple. SBI will get the liquidity. It will be able to manage its risk better because it takes lower risk in that case, and also an better investment opportunity to the public also, right? So it's basically like indirectly people are investing into the home loan. Okay, now let me go for some more concepts over here. Yes, Rafiq will be starting with ratio analysis today after break. Okay, let's look at this concept called as lease. Have you heard of this term lease? Will SBI, SBI have control over SPV? It may or may not. The band ready. Yeah, SBI, it may or may not have even control. It may be a separate entity or it may be acting as a subsidiary also. Okay. So have you heard of this term lease? What do you mean by lease? AS 19. Okay. So in that lease, we say there are two types of lease. One is a operating lease, another is a finance lease. So basic difference between this finance lease and operating lease you might be aware of. But the first thing comes up is in lease financing, the asset is purchased initially by a lessor and thereafter leased to the user company, which pays a dividend rent on periodical intervals. So in lease, what we do is we give a typical asset to a lessee, right? We will give a typical asset to a lessee, and against that asset, we will receive some sort of rentals, right? So not sort of renting. Now there are two types: finance lease and operating lease. In case of finance lease, it is passed. The risk and reward is transferred to the lessee. There is all the charges of maintaining it, repairing it. Those all are passed on to the lessee. In case of operating lease, the risk and reward remains with the lessor. That is, the responsibility to maintain, repair, everything is kept with the lessor itself. So now, as the risk is transferred to the lessee, any risk of obsolescence, that is, asset becoming useless, is borne by the lessee itself. And in case of operating lease, if that asset becomes obsolescent, it is a loss of the lessor. Lease cancelability, can we cancel in between? The finance lease is generally non-cancelable. Finance lease is generally non-cancelable. Operating lease, yes, you can cancel it. That is, once you stop paying the rent, automatically the owner will take away the asset. Cost of repairs and maintenance and operations, obviously, since the risk and rewards are borne by lessee, even this is going to be borne by lessee, and operating lease is going to be borne by the lessor. Full payout, lease is usually full payout. That is, single lease repays the cost of the asset together with the interest, and lease is usually non-payout since the lessor expects to lease the same asset over and over again to the several users. So full payout, what happens in case of finance lease? It's leased for a longer duration. Generally, it is leased for a longer duration. The lease is generally, leased out for the asset is leased out for a longer duration. So single lease itself, that one single lease, the longer duration is enough to pay for the asset. Whereas in case of operating lease, you can have it for a different users, right? If I have a, let's say, truck, if I have a truck, I lease it to a transport company. So the transport company is going to use the truck for next, let's say, 15 years, right? Most, it's leased out for, let's say, 15 years. So in that 15 years, I'll be able to recover almost everything regarding that asset because it's a long term. Similarly, if I keep on leasing this term on a short term basis, I'll be able to recover the money from different sources, from different, tenants or from different lessees. Okay. You'll find that in case of airline companies, what do you think? Do they buy the aircraft? Do they buy the aircraft? In case of airline companies, aircraft operators, Indigo, Jet, or maybe the new one, Akasha, do they buy the aircraft or do they lease it? Airline companies, are they involved in leasing the aircraft or buying it? Even ships, right? Even the larger ship, they lease it because the cost involved in it is very high, right? So because of the heavy cost, generally go for leasing it, and that's generally, what do you think? Will they prefer an operating lease or a finance lease? Will they prefer an operating lease or a finance lease? The aircraft companies, will they prefer having a finance lease or an operating lease? Short-term lease or long-term? Obviously, it will be a finance lease because they will take it for a longer duration, right? Uh, some of the other types of lease that we have is sales and lease back. Have you heard of this term? Sales and lease back? Sale and lease back. Ever heard of this? Sale and lease back. So what happens in this case is sale and lease back. See, there is X Limited. There's a company X Limited who is owning a machine A. Who is owning a machine A. Now, over here, this machine A is required by X Limited. X Limited requires the machine A, but the problem is, X Limited wants fund. X Limited is in fund crunch. It requires some value, some amount of money for investment in the business. Now, obviously, that funds are not available, but X wants this machine A. So what should it do? It will approach another company, probably Y Limited, and it will give this machine A to Y. Now, this machine A is sold to Y, and Y in turn will lease it back to X. Okay, so company X sold it and it would have paid, let's say, rupees 10 lakhs, against which Y Limited is leasing back the asset to X Limited against a per annum rental of maybe 1 lakh. Per annum rental of 1 lakh. So this is a sort of arrangement, it's a financing arrangement, in which one company sells its asset to another company, and in turn it receives the assets back, but not as a owned asset, but as a leased asset. So what happens? What's the benefit of this? For X Limited, 10 lakh is released, and it has to pay 1 lakh lease rental, and it is also able to use this machine A for its operation. So that's the sales and lease back. Is this sales and lease back clear, everyone? Sales and lease back, are we good? Yeah, correct. First sell and lease it back by the same person to the same person who sold it. Correct. True. Okay. Then coming to the next one, leveraged lease or leveraged lease. Now, what do you mean by leveraged lease? See, in case of leveraged lease, you buy your asset not by putting your own money. You buy your asset not by putting your own money, but by borrowing money. You borrow money, you take a loan, you buy an asset, and then lease it back. Then lease it to the public or lease it to someone. That's the leverage, right? So, for example, I may buy a car on loan and I will give this car on hire to someone. That's a leverage lease. Then sales aided lease. These are the specific loans which are given. These are the specific loans which are given. Which will help the company to increase its sales. Right. For example, in US, people generally don't buy this phone. Are you aware of it? In US, people don't buy iPhones. They don't buy iPhone. They get it on subscription basis. They get it on subscription basis that for 24 months you can use the iPhone, and after 24 months you can lease it back or you can give it back to the company. So this is done typically by the network providers over there, like in India, Airtel or Jio. In fact, few years back, Airtel also had this plan that you take a telecom plan of there, they'll give you the iPhone for usage for next 24 months. After 24 months, you give the phone back, and that's it. You are done with that in such case. Okay, so that's a typical lease which is given. Now, if I want to go for that plan, every month I have to pay some fees. I'll have to pay some rental or subscription fees to Airtel. For 24 months, I'll be able to use that phone. And after 24 months, I need to return back the phone. Right? So what is happening in that case? Airtel is actually pushing its sales, pushing its network services to you through that iPhone leasing. That's the typical sales aided lease that we are talking about. Okay, are we good? Sales aided lease, guys. Then we have closed ended and open ended lease. Closed ended means you cannot prematurely cancel it, and open ended means you can prematurely sort of cancel the lease. Okay. Is a sales and lease actually profitable? What's the logic behind this concept? It's quite simple that X Limited needed funds. Now, if it just went and sold this machine A, its operations would be hampered. It cannot produce. So if it wants to produce goods, if it wants to produce goods, it will have to definitely need this machine A. So it will just lease it back. So in that case, X Limited receives on the spot 10 lakh rupees, right? In the cash market, it received 10 lakh. And against that, you have to pay 1 lakh lease. And also you're able to use the machine A. What happens is iPhone got stolen. That will be covered by insurance. So in that subscription plan, you have to pay the insurance premium also for that. Okay. Next concept that we want you to discuss is, these ones. Foreign currency convertible bonds. These are some specific bonds that are issued. These are the bonds which are issued at very low rate of interest. Issuer can get foreign currency at a very low cost, or I can say foreign currency loan. Basically, foreign currency loan, foreign currency convertible bonds. These are again foreign currency bonds which can be converted to equity. Convertible floating rate notes. It's an option to convert it into a longer term debt security with a specified coupon. Protection against falling interest rate and capital gain is also not applicable in this case. These are some special features of it. So it has an option. If you buy this convertible floating rate note, you have an option to convert it into a long-term debt security with a specified coupon. If you want, you can extend the duration of the bond. You can convert it into a longer duration bond. Like originally the bond was having a tenure of 3 years. Now company has an option, or even the investor can have an option, depending on what are the terms and conditions of the bond, that they can extend this 3-year to 6-year bond. That's a convertible bond. Then drop lock bond. This is again originally a floating rate bond. Floating rate means the rate of interest that is paid to you will keep on fluctuating. So this floating rate bond would automatically convert to a fixed rate bond. It will become a fixed rate bond if the rate falls below a predetermined level, which will stay till maturity. So for example, we have issued a bond, floating rate bond, but with a condition that if the rate of interest falls below, let's say 4%, then the bond will become a fixed rate bond at maybe 6% per annum. Okay, so rate of interest being less than 4%, if the rate of interest falls below 4%, then the bond is fixed at, bond rate of interest will be fixed at 6%. Okay, so this is a case typical in which when the rate of interest fall, it becomes it changes from floating to fixed rate bond. Then obligation, holder of a floating rate note, this can sell the obligation back to the trustee at par plus accrued interest, thus making it more liquid than any note. So variable rate demand obligation. Understand this demand obligation. The demand obligation is this bond gives the right to the holder that it can give the bond back to the trustee or back to the issuer. Whoever has issued that bond, I will give it back. I want the money that is due on it. Right? So that's a variable rate demand obligation. Yield curve note. Now this is really interesting. It's actually an inverse floater in which yield increases when prevailing interest rate declines. So it's the inverse thing that if the rate of interest is falling in market, rate of interest on these bonds will increase. So if in the market, if the rate of interest falls by 10%, falls by 1%, rate of interest on this bond will increase by 1%. So they move inverse direction. Then, as we said, masala bonds, municipal bonds. Municipal bonds are basically issued by the urban infrastructure like Brihan Mumbai Municipal Corporation, Lucknow Municipal Corporation. They have got their bonds listed on the markets in which public invest the money and they use those money for the development activities in the city. Government or treasury bonds are the bonds which are issued by Government of India, RBI, or any state government or any government department also. So these are some other types of bonds. Now, there was a question which someone was asking regarding what is angel funding. Now, angel funding comes under this sort of venture capital financing. This it comes into this venture capital financing, wherein that funding is given to the startup companies. Funding is given to the startup company. So when the startup company is provided initial funding, they act as the angels for them, and therefore these are called as the angel funding. The first funding which they get for their startup is called as the angel fund. Okay, you can read up to this. I'll upload this document. You can read this later on. It's quite easy to understand, but I'll take your doubts surely. Variable rate demand obligation bond, please. Okay, variable rate demand obligation. Yeah. Variable rate demand obligation is generally a bond. It will mature only on the date of maturity. Bond will mature only on the date of maturity. But if this is the type of bond that is issued, the holder, that is the investor, can return the bond back to the company and get the money before maturity also. Okay. Is closed end bond operating lease, closed operating lease, or is closed end bond is operating lease and open ended bond is a finance lease? Sort of, you can say, Hiral. But even in finance lease, there may be some terms and conditions that we can cancel it. Okay. Yeah, sure, Rahul. I'll be uploading them. Sakshi is asking, good evening, sir. I have a doubt in MCQ 6. Why answer is the financial control is also an element of financial management. Of course, financial control is also part of financial management because when you're doing, as we have discussed, financial management comprises of two tasks. One is regarding raising of funds, and other is the utilization of funds. Raising of funds and utilization of funds. So in both the cases, you need to control the fund flow as to from where the funds are coming and where you are investing it. So that fund that needs to be controlled, and therefore it's going to be an element of financial management. Okay. Now, FRN. FRN was floating rate note. FRN is a floating rate note. So these are adjustable interest rate. That is the rate of interest that is paid that will vary according to the exchange rate. Yeah. Packing credit. It's an advance which is granted by banks to an exporter for purpose of buying, manufacturing, shipping goods to the overseas buyers. So it is advance which is given to the exporter. Packing credit is the advance which is given to the exporter. You being an exporter, you will manufacture the goods and sell it to the overseas market. So for manufacturing, you need money. So that funding will be given by the bank. That's called as the packing credit. Okay. In case of variable rate, demand obligation is a person going to get bonds at FP or at issue price at fair value. That will it will be at fair value or at a pre-decided price. Okay. Fine, guys. I'll upload this after today's session. You'll go through this, and in case if you find anything tough or anything not able to understand, you can definitely bring it to me in the next class, and we'll discuss that. Right now, we'll do one thing. We'll take a break of 10 minutes, and after that, we will begin with ratio analysis. Okay. So I'll upload this on the portal. Just right now, probably I'll upload this, but make sure you have you read this document before you come to the next class so that we can have the discussion in case you have not understood anything. Why yield curve has inverse relation? That's the instrument is structured itself, Raghavan. Instrument is decided such that it gives you inverse thing that when the market rate of interest increase, I will earn a less interest, and when market rate of interest decrease, I will earn a greater interest. Okay, so we'll take a break now of 10 minutes. Post break, we will start with ratio analysis. ब्रेक दिया सर जी। हेलो। हेलो। Okay, welcome back, guys. I hope you all joined back for the next chapter that we're going to start, which is the ratio analysis. Okay, now my first question to you before we begin with this chapter is uh, what factors are you really going to consider for investment in a company? Tell me, what factors are you going to consider for investment in a company? What things are you going to look at? What are the things are you going to consider, scan through, you make any sort of investments? What will you consider? Yep, guys. What are the things are we going to consider before we make any investment into a company? Okay, business model, management, market value. Okay, um, earnings per share. Okay, fine. Mhm. Okay. So you're saying look into the rate of interest or return on investment. Okay, let's say return on investment. We'll consider return on investment. Okay, some of you are saying to look at EPS. Okay, some of you are saying we'll look into the business. Okay, then fine. You're talking of operating profit. How much operating profit is the company making? Some are stating it as okay, growth rate in the company. Perfect. Okay, net worth. Perfect. You're saying some return on capital employed. Okay, vision, future, blah 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 blah. Okay, there were a lot of answers coming up over here. But to sum up everything, whatever you are talking of, we can simply summarize all of this stuff into probably one set of numbers. Um, One thing that all of us would like to know is the investment that I'm going to make, is it really profitable or not? So I'll look for profitability, correct? Secondly, you will say whether the company is having sufficient money for its requirement, that is short term or long term requirement. Is the company having sufficient funds for it? Thirdly, is the company performing the tasks efficiently? So we'll look at some numbers which help us to know what is the level of efficiency or activity level basically. Then we would also like to know what is the return on investment which the company is generating, right? So in all, we are looking for those areas that would provide us some sort of better things, better sense of marketability, better sense of liquidity, better sense of profitability, better sense of return. So many other things are going to be considered. Okay. Now, when you say all these terms, that is profitability, liquidity, efficiency, activity, return on investment, my question is, how are you going to measure these factors? How are you going to measure these factors? You stated that these are the factors that we will look into, sir, before we make any investment. How are you going to measure these factors? How will you know that a company is profitable? How will you know that a company is having a better liquidity position? How will you know that a typical company is having a better efficiency or better return on investment? How are you going to look into these things? How are you going to measure these terms? Yep. What is a tool? What is a set of tools that you have to measure these factors. Yep, exactly, guys. The answer to this how it basically lies in certain ratio. We will measure some ratios, we will measure some numbers, or we may measure some sort of percentages also. Some numbers, some ratios, some percentages. We'll look into it and then we will measure these factors, right? Perfect. Exactly. So, what all types of ratios that we have? What all types of ratios that we have? Let me just put it in front of you. In types of ratios, first type that we have is liquidity ratio. We have liquidity ratio. Uh, we have the leverage ratios. Now understand that liquidity ratio, it talks of short-term solvency. That in a short run, how solvent I am. Leverage ratios will talk of long-term solvency. Activity ratios is the third one that we are going to see. These set of ratios are going to inform us how efficiently we are doing the business. And then we have profitability ratios, which will tell us what is the return on investment that we are generating. So broadly, I am classifying these ratios into four categories, right? So I'm classifying the ratios into four categories, which is yeah, by calculating ratio, solvency means, hold on, I'll come to what that solvency is. Okay. Yeah. So the question someone asked me, what is solvency? Solvency, we're just going to discuss Uh, Sorry guys for the video, some technical error. Okay, let me just come back to this type of ratio. We have this set of ratios that we are going to look at. One is about the liquidity, the other is about the leverage, then activity, and then profitability ratio. Long-term solvency and short-term solvency is basically determining whether the company is capable to pay the dues, pay its creditors, whether the company is capable of paying its short-term creditors or long-term creditors. Okay. Uh, I'll share the questions, but right now, today, we are not having any questions to discuss. We are going to just focus on the concepts. Questions, we'll take it up in the next session. Right now, let us get started with the concepts. Let's say we're talking of three companies, X, Y, and Z. Three companies, X, Y, and Z. Company X has a current asset of 10 lakh. Company Y has current asset of 1 crore. Company X has current asset of 10 lakh. Company Y has current asset of 1 crore. Can you tell me which of these two companies are capable, which of these two companies are more capable of honoring their creditors or more capable of paying their creditors by looking at just current assets? Can you tell that? Can you state? Can you tell me which of these two companies are more capable of paying the creditor or they have very low chance of defaulting? Can you tell me? By looking at just this current assets figure, these current assets, are they going to indicate you whether any of these companies are is more capable of honoring it? Can you can you tell me which company is more capable? Why limited? No, dear students, no. You cannot say that Y Limited is more capable because we need to also look at how much is my current liability. So I need to look at what is the position of my current liability also, right? So let's say I'm stating that current liability over here for X Limited is 5 lakh and for Y Limited it is 95 lakh. For Y Limited it is 95 lakh. Basically, we have net current asset as 5 lakh and over here also it is 5 lakh, right? Net current asset 5 lakh for X and for Y also 5 lakh. Now, can you tell me which company is in a better position to satisfy the claims of creditors? Now, can you tell me which company is having a better capability of satisfying the claim? Which company is more safe? Can you tell me which company is more safe? Is it X or is it Y? Is it X Limited which is more safe or is it Y Limited which is more safe? X Limited, but net current asset is same for both of them. So how can you say that X Limited is more safe? Let me give you another case. Let's say company Z is having current asset of 10 crores, current assets of 10 crores, and it has got a current liability of 9 crore 95 lakh. Still my current assets is 5 lakh. So will you say that all the companies are equally capable of honoring their creditors? Will you say that all the companies are equally capable of honoring their creditors? No, sir, because even though each of my company is having current asset, but relatively, you will find that my current asset over here is double of current liability. This current asset is double of current liability, and this is not double. This is basically greater than one, but less than the earlier case, right? So to understand which of the companies are in a better position, we don't look at absolute current asset or current liability terms. but what we calculate is current ratio. And how do we calculate current ratio, sir? That's current asset upon current liability. Current asset upon current liability. So in our case, let's say the first case, X Limited. In case of X Limited, current asset to current liability ratio is 2:1. And for Y Limited, it is 1.05 is to 1. And for Z Limited, it is like 1.005 is to 1. So if I want to say, it's a this portion, 2:1. When the current ratio is 2:1, can you give me what's the interpretation over here? What's the interpretation? For every 1 rupee of dash, company has dash rupee of dash. Fill in the blank. Can you fill in the blanks? This 2:1. What does that mean? For every 1 rupee of dash, company has dash rupee of dash. We can say for every 1 rupee of current liability, company has 2 rupees of current asset. Right? So when you say 2:1, when you say 2:1, it means for every 1 rupee of current liability, company has 2 rupees of current asset. So basically, current asset is double of current liability. Right? So that's a very simple way of calculating the current ratio. Now, important point that we need to remember first and foremost, tell me high current ratio. High current ratio indicates what? High current ratio indicates what? Better liquidity position. Or we can say company is having sufficient resources to pay off its liabilities. So higher the current ratio, better it is. Always higher the current ratio, better it is. But one second. If I tell you, so there is very high current ratio. What does that mean? So for example, let's say we have company A, B, and C. Current ratio of A is 2:1. Current ratio of B is 3:1. Current ratio of C is 10:1. Can you tell me which of these three companies are better in terms of liquidity? Which of these three companies are better in terms of liquidity, A, B, or C? Which of these three companies are better in terms of liquidity? Is it A, is it B, or is it C? USA company C. Does that mean company C is doing a fantastic business? Does that mean company C is doing a fantastic business? Current ratio of 10:1, sir, very high. Current ratio of company C is very high. It's good. For every 1 rupee, you have 10 rupee of current asset. For every 1 rupee of current liability, you have got 10 rupee of current asset. Don't you think it's really good? It's fantastic. No, no, it's not. Because if you are having so much of current asset, what does that mean? When you have a lot of current assets, what does that mean? Either you will have high amount of stock, either you will have high amount of stock, or you will have high amount of debtors, or you will have high amount of cash. Because current asset, if you have got great amount of current asset, that will be ideally because of these three reasons. Either you will have a good amount of stock, or good amount of debtors, or good amount of cash. Now, if you have good amount of stock, that is huge amount of stock available in your godown. What does that indicate? There is definitely, if any of these three numbers are really high, your funds are blocked, there is opportunity cost of capital, there is no doubt in it. Okay, there is definitely opportunity cost of capital, there is problem with the huge amount of current assets that you got. But then my point is, if you have high stock, what does that indicate? If you have very high stock, what does that indicate? What is the indication that it gives? It means very high current ratio. It indicates inefficiency. So how inefficiency? If you have got huge amount of stock, it means you're not able to sell your product, right? So inefficiency maybe with regards to sale. Sir, I have got huge amount of data. I have sold the goods, but I'm not yet collected the money. What's the use? If you are selling the goods, but you're not able to collect the money, if you're not able to collect the money, what does that indicate? There is an inefficiency with regards to collection. Sir, I've got huge amount of cash available with me. What the hell are you doing with the cash? Because keeping cash idle means you're losing interest on it, right? There's opportunity cost attached with it. So it means if you're having huge amount of cash, that again means that you are investing in a very inefficient manner. So understand, very high current ratio indicates high inefficiency. So inefficiency in what sense? Inefficiency can be with regards to the selling activity, with regards to the collection activity, or with regards to the investing activity. Okay, so that's the point over here. So you said, sir, very low current ratio, not good. Very high current ratio, not good. Then what should we do? Then what should we do? High current ratio, not good. Low current ratio, not good. What is the ideal current ratio, sir? So we'll say ideal current ratio is 2:1. Ideally, you should have 2:1. Some points here and there it is okay, but generally you should have a current ratio which is in the ratio of around 2. Okay, you should have current ratio of 2:1. That is industry wide, it is considered to be a ideal current ratio. Now let me just put up an example in front of. Okay, let's say this is an extract of a balance sheet of a company. The extract of a balance sheet of a company. We have got cash, bank, short-term investment, debtors, stock, prepaid expenses, creditors of 1,50,000. So current asset, current liability position is this. If you want to calculate the current ratio, can you tell me what's the current ratio in this case? In this case, what's the current ratio over here? In this example, can you tell me what is the current ratio? Current ratio, what is it? Are you getting it as 2:1? Are you getting it as 2:1? Yes. Look at the total. So over here, creditors, it is 1,50,000 and this is 3 lakh. So, right. So I can say, is it in an ideal scenario? Is it in an ideal scenario? Yes or no? Yes, it's a current ratio. Ideal is 2:1. Now suppose these creditors come and ask for the money. How will I make the payment to them? Creditors come to me and ask for the payment. How will I make the payment? First and foremost, what resource will I use? What resource will I use to make the payment? For this 1,50,000, first resource that will pay is what? I will say, sir, cash 10,000 paid, bank 50,000 withdrawn and paid to him. It has still 90,000 outstanding. How will I clear this 90,000? How will I clear this 90,000? Because Not entire value is cleared for. You paid cash, you paid bank money, still you have 90,000 left in your balance to be paid. What is the next resort that I can do? What's the next thing that I can do? Yeah, I'll use the short term investment first. The short term investment gone 40,000. I still have to pay 50,000. What's the next thing that I will use for making payment to the creditors? Cash gone, bank gone, short term investment gone. What's the next thing that I will do? Sell goods. Stock. How can I sell the goods and then immediate cash sales may not be possible. I already have debtors in my books. Okay, I'll do one thing. I'll probably approach my debtors and I'll say, debtors, just get it converted to bills receivable and you just get it discounted with the bank. That's the best possible way to get money from the debtors, right? Now, this bills receivable that we will discount it, let's say 30,000 is discounted for 29,000. Let's say 30,000 is discounted for 29,000. I still have like 21,000 payable, right? Understand, I cannot liquidate the stock easily and get the money. Selling stock is not in your hand because there should be demand from the market, right? People should be ready to buy your goods, right? So even if you sell your goods, it will take some time to get the to receive the money from it, because it will get the stock will get converted to debtors and then debtors will pay you money. It'll take some time. So we say still there is 21,000 left out. So in spite of having the ideal ratio of 2:1, we are finding that there may be a case that we are not able to honor the dues of our creditors. Am I right, guys? In spite of having the ideal current ratio, in spite of having the ideal current ratio, you are not able to fulfill the requirement or fulfill the payment to the creditors. Now, what is making you do that? What is stopping you from doing that thing? Hypothecate, pledge, again, it's a long process, and against a stock, you may not get a very handsome amount. So basically, in this case, we have this two current assets, which I cannot use it for the purpose of making payment to the creditors. I cannot use this prepaid expense and stock for making payment to the creditors. And that's why we say we may fall short of funds. So just following blindly that your current ratio is 2:1, it means you are in a best position. That's the wrong thing. So we need to look at another ratio called as quick ratio, or also called as acid test ratio, quick ratio, or acid test ratio, which is stated as quick asset upon current liabilities. Quick assets upon current liabilities. Now, what do you mean by quick asset? So, quick asset means current asset minus the inventory minus prepaid expenses upon current liability. So basically, when we are computing the liquidity, we shouldn't consider inventory and prepaid expenses, because those are such assets which we cannot use. Those are such assets which we cannot use it for discharging our liability. And therefore, you should ignore those assets or remove it from the numerator part. So we get a quick ratio. Okay. This is one ratio. Another ratio, cash ratio, is cash ratio. Uh, that's the next ratio, which we call it as absolute liquid ratio. Absolute liquid ratio. There we consider only the liquid funds, only the most liquid fund which we can give it to our creditors without losing the value. Because understand, when we realized the debtors, we actually lost 1,000 value in them because I need to discount it with the bank. The bank charges me finance charges for that. So without losing value, what is the payment that we can make? What are the sources that I have through which I can make the payment without losing value? So without losing value, I can pay only cash, bank, and short-term investment. Only cash, bank, and short-term investment or marketable security. Okay. So here we say absolute liquid ratio is simply going to be cash, bank, and marketable securities upon current liability. That's it. Okay. So that's about this cash ratio. Okay. And you can also say that this is the cash plus bank plus current investment upon current liabilities. Okay. That's the cash ratio. So three short-term measures of liquidity we have seen. Three short-term measures of liquidity. One is current ratio, which is somewhat falling short when it comes to payable payment terms. We found that in spite of having 2:1, it may be possible that we may not be able to fulfill the requirements. Second is the quick ratio, and third is the cash ratio. Okay. Now the next question immediately arises, sir, how do we check if we have sufficient quick assets to meet the day-to-day expenses? How do I know that I have sufficient quick from which I can say that I have sufficient quick assets available for my day-to-day expenses? How can I check that? How can I check that, guys? Yeah. So let me give an example. Let's say you have a pocket money of 3,000 per month. Okay. You have a pocket money of 3,000. Now, if I tell you that this has to be used over a period of certain time period, and you say that on an average, your daily expense is rupees 100 per day. But if I tell you that balance available with you in your wallet is rupees 1,800, you've got 1,800 as balance in your wallet. Now tell me, what is the number of days for which sufficient cash is available with you? What is the number of days for which sufficient cash is available with you? For how many days do you have sufficient cash with you? For what number of days do you have sufficient cash? Yep. 18, exactly. So you'll say, sir, this is 1800 divided by daily expense of 100 rupee. My daily expenditure of 1800 divided by 100 rupee. So I've got a cash equal to how many days? 18 days. Right? 18 days of cash is what we have got. Perfect. Right? So whatever funds you have in business also, whatever funds you have like the cash plus the bank balance that you have got plus the marketable securities that you have got. Cash balance, bank balance, plus the marketable securities that you have got. All of them are going to be used for what? For daily operating expense. Okay. So those three we have to use it for the purpose of daily operating expense. Cash, bank, marketable securities, those are going to be used for daily operating expense. So I want to know how many days of such cash, bank, and marketable securities do we have? So first up, that same funda that you said over here, 1800 divided by 100, that same thing I'm asking over here in the term of basic defense interval. So basic defense interval is basically whatever cash and bank balance you have got plus you have got marketable securities, and plus we also say the net receivables that we have, that is the amount that we are supposed to be receiving from our debtors and bills receivable total together over a future term that we are going to get, divided by operating expense per day. And of course this basic defense interval is going to be in number of days only. Okay, that's going to be number of days only. So this is again a measure that we have for basic defense interval, which is cash bank plus marketable security plus net receivable divided by operating expense per day. That will give you the number of days of funds that you have got. Now, daily operating expenses. Daily operating expenses. We need this, right? Daily operating expenses. So how do we know what the daily operating expenses? The daily operating expenses, I need to take the total operating expense and divide it by number of days. Total operating expense divided by number of days. So basically, it's going to be your cost of goods sold plus the selling expenditure plus the general expenses that you have got, right? Now tell me, in this COGS or in this selling expense or in this general expense, can we have some non-cash expenditure? Can we have some non-cash expenditure in this, which I need not pay in cash? Can we have some expenditure in COGS or in selling expense or in general expenses on which we need not pay some expenses in cash? Can we have any such expenditure? Of course, yes. So there may be some amount of depreciation and amortization. There may be some depreciation and amortization. In this, COGS may comprise of depreciation on machinery, right? Then we may say, sir, selling expense may have depreciation on selling man, or general expense may have depreciation on office equipment. So I don't want those expenses to be clubbed over here because that is not something which I'm going to pay in cash, right? I'm not going to pay that in cash. So can I say I need to remove the depreciation and amortization from here and divide it by number of days. Number of days in a year. Okay, that's the number of days in a year. Yeah. So this basically tells you for how many days you have cash sufficiently available with you. Now tell me this basic defense interval, higher the better or lower the better? This number, basic defense interval, is it higher the better or lower the better? Higher the better or lower the better? Tanvi, why did you? Tanvi is asking, why have you taken net receivables in basic defense interval? Okay. I have taken this net receivable because this is what I'm going to receive in future, right? I need not pay that immediately. I need not pay my operating expenses immediately. I'm going to pay the operating expenses in a gradual term. So during that gradual term, I'll be able to recover this money at the earliest. So therefore, I have taken the formula takes the net receivable in the numerator. Yeah, so basic defense interval better, higher the better, lower the better. Definitely, sir, it is higher the better. So basic defense interval higher the better. But again, if you have too much of basic defense interval, very large defense basic defense interval, it means you have got a lot of cash available with you, which indicates again you're investing inefficient. Okay, fine. Now let me take another example. Let's say three companies, P, Q, and R. They've got owned funds. P has got owned funds of 10 lakh, nothing of borrowed, but yes, total funds to be raised is 10 lakh. Q is having some amount of loan, 5 lakh, another 5 lakh. So total of 10 lakh. R is having owned funds of 2 lakh, borrowed funds of 8 lakh. So total of 10 lakh. Okay. Now, obviously, the total investment that it has got or the total assets is going to be 10 lakh itself. Now, my question to you is, out of these three companies, which company is stable in a long term? Understand that when I talk of owned funds, includes equity share capital, preference share capital, reserves, and which should be net reserves. That is after subtracting the fictitious assets. That is P&L debit balance, any deferred advertisement expenditure, right, or discount on issue of debentures. All those things are fictitious assets which are lying on the asset side of balance sheet, but they are actually not assets. Okay, so that's the owned funds totality. So we say P is having owned funds of 10, Q is having 5, and R is having 2 and 8. So out of these three companies, can you tell me which company is having or which company is stable in a long term? In a long run, which company do you feel that is going to be a stable company? Which company is going to be a more stable company? Is it P, is it Q, or is it R? Which company is a more stable company? P Limited? P Limited? Yes, Pooja, I'll be uploading this notes also. Which company is better? P Limited? Yes, absolutely right. P Limited is more stable in a sense that it has got the funds as own funds. It doesn't have any loan. Now, any company which doesn't have any loan, it's the best one because it's able to face any sort of crisis because there's no loan that we need to pay out. There's no loan that the company needs to pay. So when there's nothing to be paid out, obviously P Limited is in a better situation that if any crisis comes in, it will be in a better situation to handle as compared to Q and R. Okay. So how do we measure these things that which company is more stable in a long run? In a long run, we can say that's computed by using some of these ratios as long-term solvency ratio. The first ratio that we have is proprietary ratio or equity ratio, which tells you that out of your net assets. Now understand this: net assets is what, sir? Fixed assets plus current assets plus any sort of investment you have minus current liability. So this net asset, I'm stating this net asset, out of this net asset, how much is the shareholders fund? How much or what proportion is the shareholders fund? So out of net asset, what proportion is the shareholders fund? So we say net assets in the denominator. In the numerator, we say it is shareholders fund. Shareholders fund. So equity ratio, it tells you that out of net assets, how much is the shareholders fund. So basically, in shareholders fund, we can say it stands as equity share capital plus preference share capital plus reserve minus any fictitious asset. So can you tell me in our case, in PQ and R, what is the proprietary ratio or what is the equity ratio? Proprietary ratio or equity ratio for PQ and R. What is the number? What is the amount? What is the number for proprietary ratio, equity ratio? Can I say for P, sir, entire funds, or I can say 10 lakh fully, or I can say 100% is the proprietary ratio. 100% is the proprietary ratio. So out of 10 lakh, entire 10 lakh is by owned funds, so 100%. What about Q and R? What about Q and R? What's the proprietary ratio? Understand proprietary ratio formula that we have? The shareholders fund or the owned funds divided by net assets. Net assets is this. The net assets is fixed asset plus current asset plus investment minus the current liability. Yeah. Tell me what's the equity ratio for Q Limited? Can I say it's going to be the 5 lakh is the owned funds over a net assets of 10 lakh, which is 50%, right? And what about for R? So for R, it is just 2 lakh out of 10 lakhs. So that works out to be 20%, right? And obviously, from this, what can you say? As the equity ratio is higher, what can you say about long-term solvency and what can you say about the risk? Okay, by the way, this equity ratio is generally shown as a percentage. It is shown as a percentage, which tells you what percentage of your assets are funded by shareholders. Yeah. When the equity ratio is high, as we saw that this is 100, 50, and 20. As the equity ratio is high, what about the long-term solvency? Long-term solvency is also high, but the risk is low. Okay. Then coming to debt ratio. Coming to debt ratio. Debt ratio means this debt ratio. This number means what is the total debt upon net assets, or it tells you what percentage of your assets are funded by borrowings. What percentage of assets are funded by borrowings? Okay. So this total debt, you can also say somewhat that it is 1 minus equity ratio also, or you can say this as 100% minus equity ratio. 100% minus equity ratio. So in this case, you can say debt ratio, that it is 0%, here it is 50%, here it is 80%. So tell me, what about debt ratio? Long-term solvency, high debt ratio indicates what solvency ratio? Debt ratio indicates what solvency ratio? High debt ratio indicates low long-term solvency and high risk. Here you need not multiply it by 100, but basically When you calculate 10 lakh by 10 lakh, that's just 1. So 1 is what? 100%, right? So if 5 lakh divided by 10 lakh is zero point 0.5. So zero point 0.5 means it's 50%. Right? So it's intuitive to understand these percentages rather than keeping it in ratio. Okay, therefore we express that as a percentage. Okay, now the next one, debt equity ratio. Next one that we have is debt equity ratio. What is debt equity ratio? As we look into this, for every 1 rupee of owned funds, how much is the borrowed fund? For every 1 rupee of owned funds, how much is the borrowed fund? So formula wise, we say debt equity ratio. As the name says, it is debt, which is borrowed funds, upon equity stands for owned funds. Remember here, equity stands for owned funds. And when I say owned funds, it includes equity share capital. When I say owned funds, it includes equity share capital plus preference share capital plus reserves minus the fictitious assets. That's the denominator. So in the own funds, we have equity share capital, preference share capital plus reserve minus fictitious assets. And in the numerator, you will have short-term and long-term debt. Short-term and long-term debt. So both short-term and long-term debt will be there in the numerator. Total debt is equal to total of liability side. No, Rahul, it's not total of liability side. In the liability side, you have equity share capital also. Total debt means total borrowings, loan that you have taken, not the equity share. So, Mansha, total assets less current liability is less long-term liability. No, not long-term liability. Only total assets less current liability. Here, net assets means it is only current liability is subtracted. Okay. So that's debt equity ratio. Now for debt equity ratio, will say higher debt equity ratio means again low solvency because you have debt more and equity less. So obviously low solvency and high risk. Low solvency and high risk. Can you tell me what is debt equity ratio over here? In our example, debt equity ratio. Debt equity ratio. It's always a ratio, by the way. Debt equity ratio is 10 is to 0. Over here it is 5 is to 5 and this is 2 is to 8. Sorry, not 2 is to 8. Oh, debt equity ratio is here it will be 0 to 10 and it will be 8 is to 2. Okay. Karthik, net fixed asset means it is after subtracting the depreciation. Karthik. Net fixed asset means after depreciation. Net assets is owned funds plus long-term debt. Yes, Aditi, you can say that. Net assets is owned funds plus long-term debt. Total debt is total liabilities minus shareholders equity. Kushi, yes, correct. Total debt is total liability minus shareholders equity. Shareholders equity as well as reserve. So here we get debt equity ratio as 0, 1 is to 1 and 4 is to 1. Okay, net asset is same as capital employed. Yeah, you can say net asset is same as capital employed. Correct. So you can say this, the last company was having the highest risk and of course highest debt equity is also going to give you highest risk and solvency is lower in that case. Okay. Now, before we go for the next ratio, rather we can say next ratio is not what we are going to discuss. We'll That's the capital gearing. We'll come to that capital gearing at a later point. What we need is first, yeah, we need to look at this return ratio. Before that, if we see the query, can we calculate basic defense interval? No, Hiral, you cannot calculate that basic defense interval as quick assets upon, because in basic defense interval, numerator includes the receivables. Okay, so you cannot use quick asset upon the daily operating expense. Okay, now coming to the return ratios. Uh, return ratios in the return ratio calculation, we need to look at this income statement first. Let's have a look at this income statement. Sales of 1 crore, variable cost is let's say 50 lakh, contribution is 50 lakh, fixed cost of 20, EBIT of 30 lakh, interest is 10 lakh, PBT is 20 lakh, tax is 6 lakh, PAT is 14 lakh, net profit for equity shareholders left is 10 lakh. I hope you guys are aware of this income statement. You guys are aware of this sort of income statement, right? You start with sales and come to the net profit for equity shareholders. Still, I will just make you go through this income statement once. Company is generating sales of 1 lakh, against which it need to pay 50 lakh variable cost of production. It has your contribution of 50 lakh. Another expense that the company has to pay is 20 lakh of fixed cost. And after that, what is left out is EBIT. What is left out is EBIT. This EBIT, tell me, it belongs to whom? Does this belong to only the equity shareholders? Can equity shareholders say that this entire EBIT of 30 lakh is their income? Can equity shareholders say it on those lines? That entire 30 lakh of EBIT is their income? Yeah. Can they say it? Can they say that this entire 30 lakh is their income? Can the EBIT say it like that? Can the investors or the equity shareholders say that uh, 30 lakh belongs to them? No, of course not. Because from this 30 lakh, you need to first pay, from this 30 lakh, you need to first pay interest. Then only you can think of paying to your equity shareholders, right? So EBIT of 30 lakh is an income for all our investors. From that, I need to pay interest. Then I have PBT. From that PBT, I need to pay first tax. Before payment of taxes, I cannot pay dividend to my investors. So this PAT of 14 lakh, is this 14 lakh belonging only to equity shareholders? Is this 14 lakh belonging to only equity shareholders? Does this 14 lakh belong to only equity shareholders? No, it belongs to both equity shareholders as well as preference shareholders. But who is having the preference? Who is having the preference to claim money? The preference share. The name suggests that they have a preference to claim rights over the profits of the company. On this 14 lakh, the first right that they that is having is by the preference shareholder. So you pay preference dividend, and finally this 10 lakh is the income which is there for the equity shareholders. Finally, this 10 lakh is the income for the equity shareholders. Am I right, guys? So you understand this flow of income right from sales till your net profit for equity shareholders. The profit, the income that is generated, the cash flow that is generated is being distributed by company into various investors. So first of all, whatever is earned, that is the earnings of the entire company, or this is the income for all investors, or you can say this is income of company. Then you can say this is income for owners and this one is the income for equity share, right? So I hope you understand these things. Now, based on this understanding, we have to do some sort of return ratio. Okay. But those return ratios, we will take it up in the Thursday's class. Okay. Because I don't want to rush through these ratios right now. Okay. So I'll just take up any queries that you have got right now. Mansha is asking in FM, we consider only cash flows to assume these income statements that we consider is same as cash flow statement. No, Mansha, over here we are not considering the cash flow. As I said, cash flow is considered, but for computation of ratios, accrual concept is also applied. Any other queries, guys? Or shall we call it a day? Any other sort of queries you've got? Or shall we call it a day? Just wait for maybe a couple of minutes and then if there are no queries, they'll call it a day and we'll meet up on Thursday. In module, equity ratio and property ratio are different. Yes, they are different, but the calculation remains the same. All clear as of now? Okay. What is carbon credit? That's carbon credit is basically when you are into the production industry, how much your how much carbon dioxide you are putting out, and how much you're you're planting trees so that the carbon dioxide are getting absorbed. So carbon that you generate and carbon that is absorbed into the industry. Yes, this chapter is important from the practical perspective. Equity ratio cover only equity share capital, not coverage ratio. Will have it later, Hiral, not right now. Net receivable is after discount and RDD. Yes, Kunal, true. Okay, fine. So there are no further queries. Thank you, Rahul. So let's stop here for the day, guys. Uh, we'll take up the discussion in the next class. Okay, fine. Let's stop here, guys. Any further? I'll upload. Think I have uploaded the PDF of the previous one. You can go through that. Any issues, we can discuss it definitely in the next class. Okay, thank you. Thank you, everyone. Good night. Take care. See you in the next class, guys. Yes, done, sir.